late night, they ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, remaining so focused. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, welcome to Data Driven Value, where we show you the tools and teach you the skills to help you take your financial freedom into your own hands. So today we're going to jump back into the educational side of things. I want to talk about risk in terms of approaching these markets. There is inherent risk that comes with investing, and there are things that we can do to structure our portfolio to mitigate that risk or kind of play into our own personal risk tolerances. So I've said before that not everyone's strategies, goals, or risk tolerance is the same. Some people prefer to kind of take more speculative risky bets, whereas other people might just want to look for kind of those safer, better risk adjusted returns. So we're going to talk about structuring our portfolio from a top-down approach. So we're going to get right into things here, and I'll show you some tools we can use, as well as kind of how we're going to look at going about this in terms of a risk adjusted portfolio. So overall, we kind of need to look at our investment portfolio as a whole. So that includes everything from stocks, like traditional stocks and index funds. It includes real estate. It includes investments into precious metals. It includes our speculative assets like Bitcoin and crypto. So I've showed this slide before, but I do want to just bring it up again to show you guys kind of, this is a decent way to structure an overall portfolio. And so we see here, stocks and index funds just weighting a lot of your portfolio towards the like SPY in particular. We'll also talk about a couple other options as Canadians that we can invest in. But essentially, the SPY does kind of just trend up and to the right over long periods of time. That being said, it can go into these periods of substantial downtrends of 25 to 30% in recessionary periods. But for the most part, the stock market does usually recover and continues trending higher. We've seen that through multiple huge crashes. So the dot-com bubble, we saw the great financial crisis, we saw the COVID crash. All major economic events really scared a lot of people, but those were actually some of the best buying opportunities in the markets, and those who took advantage of those are really reaping the rewards now. So we do see that essentially getting into the SPY is a pretty good risk-adjusted asset for a lot of people, depending on kind of what your own strategy is. So for a lot of young people, just dollar cost averaging into the SPY is going to be a really good strategy over kind of the long term. That being said, we can kind of also increase our exposure in some riskier assets and include some even less risky assets. So overall, we're just coming up with an overall portfolio that's got, we have most of our money in kind of our safer assets that are expected to kind of trend up with time. We've got a little bit of money in kind of our more speculative assets, more volatile assets that might outperform in the near term. That being said, there is also that risk to the downside. We've got our safe haven assets. So when I talk about safe havens, I do kind of mention them as bonds, precious metals, other less volatile assets that kind of during risk-off environments or during recessionary periods, these safe haven assets tend to do very well, or at least hold their value. So things like gold, real estate, bonds generally do well. But we'll break it down even further. And then cash. So having just having a kind of cash position aside to take advantage of any substantial market dips, because if we did find ourselves in a recessionary period where we get a substantial stock market correction, you're going to want to be able to take advantage of that as best as you can. So just maintaining a cash position is pretty key in my opinion. What you can do is you can have your cash position, maybe you're kind of putting that money into the market on a DCA basis, so dollar cost average on a schedule, and then you're looking to replace that cash. So you're not going to have a 20% cash position that you just kind of dollar cost average into the market down to 0%, and now you're just fully allocated, not able to actually have any cash left to purchase any dips. So if I have a cash position, and I'm kind of deploying it, then I look to replenish that cash position from my income. So really look to do that. We'll flip over. We're kind of going to break down all the individual portfolios. So this is what I talk about. We talk about this is kind of our macro portfolio. This is all of the assets that we have, and then to really get a good idea and come up with a good strategy, we're going to break them down into their individual categories. So if we start with our traditional finance or our stock market portfolio, I kind of just have a few different categories here that could, decent opportunities, good investment opportunities. I do believe that will do well in kind of the long term. So we do see that index funds are a good portion of the portfolio. So things like the SPY, VFV, or the XEQT are good options. So VFV and XEQT are going to be more for the Canadians. If you only have access to Canadian tickers, VFV kind of tracks more similar to the SPY. XEQT is a little bit more Canadian weighted, so it depends what kind of exposure you want. If you want more US stock exposure, then something like the SPY or VFV is going to be what you're looking for. And if you want more Canadian stock market exposure, then something like XEQT is going to be what you're looking for. These are generally the index funds that you can dollar cost average into over a long period of time and kind of track that broad market performance. So we did kind of look in the last 10 years, you gained about 10% return per year on average investing in the SPY or VFV. So it's a good indication that a strategy like this can definitely outperform inflation in the long run, which is currently at about a 4% per year running average. So we do see just going into the SPY in itself really did outperform inflation. We see here our next biggest weighted position is our cash position, and same thing that we do with our overall portfolio. Cash is there to add on the dips, or if we're doing a dollar cost average strategy, then we use our cash position to dollar cost average, and then again look to replenish your cash position with income as you can. So I talked about trying to saving money here and there, cutting out expenses, and being able to put aside excess cash. The bigger we can build that cash position, the kind of more advantage we can take in the event of a large downturn in the markets, really wanting to kind of capitalize on those generational buying opportunities. So we do see cash pretty high weighting here, 20 to 25% I feel is a pretty good amount, especially just with the current stock market kind of the way it looks right now. We're right at all-time highs. We're not sure if we're going to be able to break out and put in those new highs and continue our uptrend, or if we're due to just break down. So we're kind of, I've said before, we're in this no man's land. So right now my cash position is actually quite a bit heavier. That's because I used my speculative assets. So I was kind of in a bunch of different assets that were they're highly risky, highly speculative. I saw the weakness kind of brewing in the market. I saw the global trade war tensions rising, and I de-risked those trades. So that being said, I'd taken profits. I've closed the trades that I don't have conviction in. I've put that money into my cash position, and now either we continue up and we put in new highs and we continue our uptrend, in which case my current allocation, so all the stuff that I've held and plan to hold for years, I still have that. That can continue to appreciate with the market. Or on the flip side, I'm correct and we have a market breakdown, in which case I have a lot more cash I'm able to put into the market at lower prices, take advantage of that dip opportunity, and then ride it back to the upside. So that's kind of my plan with my cash position. I like to replenish it and then kind of not essentially selling it down, but just buying into the market, and it comes down and it gets to a certain point where I say, okay, I need to start adding more cash to my position. How can I do that? Do I have trades that I want to de-risk that are in profit? Do I have income coming in? That kind of thing. So all different kinds of ways to kind of add to that cash position. It's all going to kind of be dependent on your personal preference. So we do see just weighting the majority of our portfolio to something like the SPY or VFV is going to remove a lot of that kind of long-term risk. You don't have to worry about picking the best individual stocks that are going to outperform the market, because that can be stressful. And for a lot of people, as I mentioned, just that dollar cost average strategy into the SPY on a long time period is going to yield really good results. So then we see we've got a few other things we can look at here. So if we look at individual stocks, it is kind of, it's interesting and fun to go out and look for those companies that you really believe in. So a lot of these I would say are going to kind of focus around the Mag 7 stocks, or the Magnificent 7. So this is essentially a group of stocks that have kind of outperformed the majority of the market. If you actually look into the SPY, you'll see that over 50% of the gains were actually made from these 7 companies alone. So it really shows you how much market share they have. Those are Google, Apple, Amazon, Nvidia, Microsoft, Tesla. So all household names, all going to to have like huge futures that, you know, they have a great history, not a lot of risk getting into these stocks. But when I talk about that, there's also the risk at the current prices. So just because these stocks don't technically have a lot of inherent risk in the long term doesn't mean there isn't short-term risk to the downside in terms of price action. That's why we adopt our DCA or our dynamic DCA strategy, or we're buying in based on technical factors, making sure that we're not buying into resistance. So we see here just having a little allocation here into individual stocks. Maybe you really like Tesla and you want to invest in them, and you like AI and you want to get some AI exposure on an individual stock. So you might be looking at a combination of a few of these just for a little bit of additional exposure, slightly more risk, but also the potential for more returns in the long term. Moving down, we see bonds here. So for most people watching this, I'm going to recommend ETFs that track the performance of government bonds. If you do buy actual government bonds, then you have to wait for those bonds to mature to really get the return on them, whereas these ETFs just track the performance of it, and lots of the times they also return monthly dividends. So if you're looking for something to kind of give you a little bit of capital every single month, having positions or having a portion of your portfolio in bonds can give you that kind of monthly yield, as well as that hedge to the downside. I did talk about how during recessionary periods we generally see the bonds kind of start to go on and outperform. I'll show you that kind of over there. So depending again on your risk tolerance, you know, you might have bonds weighted a little bit lower. If you need that kind of safety, you want the monthly yield, you could weight your bonds a little bit higher. The reason I don't weight bonds very high in my own personal portfolio is kind of based on the data in the past. It hasn't really outperformed inflation in the long run. That's why kind of a lot of people are moving away from this traditional investment portfolio that was either, you know, 60-40 stocks and bonds or 50-50 stocks and bonds, depending on kind of your risk again. So we do see kind of people moving away from the bonds and more into these index funds that track the stock market. That being said, I'm going to show you a chart looking at the 20-year US Treasury bonds, and they look really attractive kind of at the price. So just because everyone's kind of left the safety of bonds and looked for more speculative returns in the SPY doesn't mean that it's a bad bet here or there isn't money to be made. It's a good, again, as I said, it's a good hedge against the downside. So if we see a recession, you know, there's going to be a lot of flight to safety of bonds because of the guaranteed yield that they provide and the safety of the US dollar relative to kind of the highly speculative assets. So we do have, you know, a little position of bonds here in our portfolio. I also have a position in, it's called TLT, so it essentially tracks the US 20-year Treasuries bills. So I do have some exposure in US bonds myself. I kind of prefer more exposure in the US markets as opposed to Canadian markets. That's just due to the liquidity in the US markets. There is a lot more liquidity, a lot more money flowing around, and a lot more interest from international investments within the US markets. That's just something I've realized over time. So I try to I have a lot more US than Canadian exposure, and there are ways we can get US exposure without having to have US dollars. So there's ETFs or index funds that essentially track these US companies, but they're denominated in Canadian dollars, so you're able to purchase it. We also see utilities here. You know, if you're interested in utilities, it's always a good thing. You know, people always need energy. People are always going to need water, communications. These kind of things are going to continue growing and adopting with time. So having a little allocation to utilities, it's another kind of less volatile, less risky potential here. Generally, looking for index funds is going to be the easiest and lowest risk one without having to kind of cherry pick those individual companies and hope that they do well. So we'll flip over. I touched on this before as well. So we also break down our crypto portfolio. So overall, break down our overall portfolio, get into the individual portfolios, break those down. And Bitcoin, we do see obviously similar to how we weight our stock portfolio. Bitcoin is the oldest and the most secure, the safest. It's weighted the most. Cash is our second highest weighting, so we can take advantage of the dips. Ethereum and our blue chips, so that would be like the magnificent 7 stocks of Bitcoin and crypto. that's what we're looking at here with Ethereum and our blue chip stocks. And then speculative alts, again, that's kind of just if you want to take a little bit more risk, buying into low caps, hoping to kind of gain on that volatility. But remember, with the higher volatility comes higher risk, and yeah, you have to understand that and be prepared. Again, I talk about not everyone having the same strategy or risk tolerance. That's a big thing I want to emphasize. We all don't have the same goals, but we all want to make money. The way we do it and the way we structure our portfolios is going to change a little bit. Okay, so flipping over now, I want to talk about risk in the markets. So when we talk about our own portfolio risk, we need to understand kind of what's going on in the markets in terms of macroeconomic events here. So we can take a look. I've got this macro recession risk dashboard here on Into the Cryptoverse. So you're welcome to come over here, get a free account, check out some of the tools. This is a paid tool right here. So I'll just be here showing it to you every once in a while. But essentially what it's doing is measuring a bunch of different macroeconomic factors here, from employment to national income, production and business, as well as the interest rates over here. So it just gives us a good idea of when certain metrics are looking a little bit scary in the market. So our treasury yield spread is the only one looking really concerning right now. Generally, we do kind of see this yield spread uninvert and then see a recession kind of follow it within the next few months or so. So that's something we're following. It has uninverted, showing us quite a bit of risk right here. But in terms of unemployment and our national income and products, still relatively low risk. So we could continue just climbing that wall of worry. Government does a great job of playing kick the can. So who knows how long this game could go on. That's why I'm just waiting for that confirmation of a breakout or breakdown before I get too aggressive in anything. But we do see here just a broad overview of the macroeconomic numbers, seeing not a lot of risk, but this is a pretty concerning thing for the yield curve to uninvert here, because it has signaled recessions in the past. But we'll pay attention to that as we go forward, and maybe if we start to see some of these other numbers start to look a little more concerning, that might be a signal that we could be due for some downside. We can take a look at our crypto risk indicator dashboard, similar to our macro recession risk here. Essentially, we just have this summary right here. So a total risk of 0.391. So under neutral, leaning more towards less risk. We've got our price metrics here at 0.45. So again, a little bit less than neutral. On-chain metrics a little bit above 0.5, so slightly above neutral. Social metrics very low. So also tons of different indicators right through here. These indicators are all the ones used to kind of come up with the metric right here. So we do see, if you want to look into all the individual ones, we can see which ones look overheated and which don't. Obviously, we see the YouTube subscribers, kind of social metrics thing here, still very low. Not a lot of people returning to the space, not like we saw in the prior market cycle. But we'll flip over now. We're going to get into some more portfolio-specific tools. So this is a weighted risk tool with the ITC program here. Essentially, you can just come in here, put in different crypto assets, and then it'll take the current risk of that asset, your weighting here, and then give you this number over here, this overall weighted risk. So just looking at it, if we were to come in and you had a portfolio of 50% Bitcoin, 15% Ethereum, 5% Dogecoin, and then 10% in Solana, Chainlink, and Render, your total portfolio weighted risk is going to be 0.543, which is slightly above neutral. But you also see, by adding some of these other ones here, although Solana is kind of slightly riskier than Bitcoin right now, the other ones are a little bit less risky, so it kind of brings the weighted risk of the portfolio down slightly. So just a good little tool to kind of tell us, if you're building a portfolio in crypto, what is the current risk? Is it above neutral, below neutral? What is it relative to Bitcoin? And then we can just move on from there. We'll take a look at our modern portfolio theory. So this is a way we can also kind of gauge how we structure our portfolios to come up with the best risk-adjusted return. So our Sharpe ratio essentially is going to show us what is the best return on a long period of time. It generally works better for less volatile assets, where our Sortino ratio kind of works better for more volatile assets. But you can see here, if we just hold Bitcoin and Ethereum, the best one we're going to get here, so the max Sharpe ratio and the max Sortino ratio that we can achieve comes here with an 83% allocation to Bitcoin and a 17% allocation to Ethereum. So you do see, as you kind of go down here, you can increase the volatility. Obviously, the higher risk is going to lead to more volatility. So we can also add, let's say if we add cash here, because we do like to have a cash position in our portfolio to take advantage of dips. So we'll recalculate this and see what it spits out. So basically what you see, the max, it's not the max Sharpe ratio we can get here, but it is our max Sortino ratio and just shy of the max Sharpe ratio. So this is going to be the best risk adjusted portfolio. It's 58% Bitcoin, 12% Ethereum, and 30% US dollars or cash, looking at a volatility of kind of 0.49, almost just like right in the middle. So that is kind of going down here. You see, we come down, and as you weight it towards kind of less volatile is going to be more cash, lower allocations, and the more volatility you want is going to be less cash. Or the more volatile you want, less cash, more allocated into Ethereum or into Bitcoin as well. But Ethereum being riskier than Bitcoin, obviously, is going to attribute to that higher volatility. But just for a general sense, you can see for most people, even a 50, like anywhere from 50 to 60% allocation to Bitcoin overall in their portfolio is going to be pretty good for the most part. I do argue that every crypto investor should be focusing on Bitcoin as a major part of their portfolio before getting into more of the speculative assets. Those altcoins are really where you can hurt yourself if you get in at the wrong times. So Bitcoin and ETH are generally a lot safer in terms of a long-term DCA strategy. So this is a good little tool. We can come here, plug in different little assets. There isn't a ton of options right through here. So if I add Doge right now as well, let's say you want some exposure to Doge. What is the best risk-adjusted modern portfolio? We see here 50% Bitcoin, 17% Doge, 10% ETH, and 25% cash. So you do see as you add different assets, it changes the allocations, but ultimately aiming for that max Sortino ratio and max Sharpe ratio. Flipping over here, this is another tool from ITC. So these are great tools. It's an amazing website. Lots of data for you to come and view. Tons of free tools as well as paid tiers. But we can kind of get a sense. This is our crypto screener. So we do have the asset name, we have the price, performance, market cap, the risk in fiat, so that's the US dollar or cash risk. And we've also got the Bitcoin risk. So assets that are kind of crypto should be valued against Bitcoin because Bitcoin is the king of crypto. We need to make sure that if we are getting into alternate assets that they're likely to outperform Bitcoin going forward. Otherwise, it doesn't make sense to take that additional risk. So we see here, if we want to just look at the US dollar risk and kind of look here, so XRP essentially is the highest risk of these altcoins right now, and then kind of going down the list we just get to lower and lower. So you can come here, take a look at this, see what a coin looks like on its fiat risk. Obviously we want to make sure that we're kind of buying lower risk coins as opposed to higher risk, and then we can also take a look at the Bitcoin risk here. Some of them kind of have their risk on Bitcoin. So Aave here, quite risky against its Bitcoin pair. Solana is not quite as bad compared to its US dollar risk. You see like quite a bit riskier in terms of the US dollar price as opposed to the Bitcoin price. And then just coming down this list, you can see just the prices denominated both in US dollars and Bitcoin. It gives us a good idea of valuing our assets in two different ways, making sure they're going to outperform going forward. And then we also see over here, we have our categories. So we can really break down how we diversify our altcoins or our crypto portfolios to capture those narratives. So when I talk about narratives, that's kind of what I talk about different like sectors in crypto. So AI is a big one. Layer ones are a big one. You can see right through here. Meme coins are a big one. So just breaking down it by category and then risk level just really gives us a good visualization of what might be a little bit risky and what might be a little bit less risky in the current market conditions. Moving on, I want to talk now about risk reward ratio. So when I talk about risk reward, we're going to come here and I'm going to show you. We have this tool right here. This is our long position tool in TradingView. When you click it, so basically you'll click it, it ends up on the chart here, and then you can kind of drag it wherever you want. But I have one already drawn out here. So we did see, this is TLT, this is that 20-year treasury bond here. We look at it on the very high time frame. You can see, look at this all through history back to 2002 here. We just had this horizontal support, so acting as support through here, through here, through here, through here, through here, holding all the way up until over here. We came back, tagged this support. Looking at that, that is amazing horizontal support for TLT. Looking at it, so we pull our long tool here. And then we see, if we look, we put our stop loss just below this support level. We want support, or we want stop losses below heavy support so that we avoid getting wicked out of those. And then we see here, if we drag our tool up to certain levels here, so depending where you want to take profits is gonna kind of vary on your strategy. So even if we take profits at the first kind of zone of resistance that I see right here, you see a risk reward ratio right here of 3.06. Let me see if I can zoom in on that to give you a closer look. You see, yeah, so 3.06 on the risk reward. That means that to the upside, if we reach our target here, you see 17% return is what we're expecting. And then alternatively to the downside, we're risking about 5.5%. So that's what gives you this ratio of 3.0. And then if we flip over here, this shows you kind of the win rate required to break even. And then anything above that is what you need to be profitable. So you see, if we target a 1-to-1 risk to reward ratio, we need to be right 50% of the time in the minimum just to break even. So you kind of look at the trade. If we only were expecting to be able to get up to like maybe we're only expecting to go up 5%, and you're risking, let's say you're here, you're risking risk 3.7% to the downside. So we just adjust this, move it just a little bit below this support. You see that risk reward ratio is 1.35. That's not good enough in my mind to make it worth that trade, worth the risk, because you see, if we're wrong, then we need to just if we're wrong on terms of a 1-to-1 reward ratio, then we only have a couple chances really to get it right. As you go down here, you see when you get to a 3-to-1 risk reward ratio, you really only need to be correct 25% of the time to break even. The goal obviously is to be at least 50% or more profitable in terms of our win rate here to kind of beat that break even point and be profitable. And then kind of the higher you go, the better, kind of the less win rate that you need. That being said, you can't just drag these tools wherever you want just to kind of fit your reward ratio that you see fit. It needs to coincide with levels of support and resistance. So that's why I have this first resistance zone marked right here. If I was to enter this trade, that would be the first place I would consider taking profits. So yeah, looking at a 17% return. If we had our stop loss, we'll put it a little bit below these lows just to make sure that if we do come back here, that we're not risking just getting stopped out of this trade on kind of a scam wick and then reversing back to the upside. So you see here, 3.59 risk reward ratio satisfies our requirements, and then there's also the potential for it to continue going up even higher. So if we look back in time here, essentially this is what acted as resistance all through here. Every time we came down to this support zone, we bounced up to this resistance zone. We did it 3 times before breaking out and then really getting above it, holding it as support through here, and now we're back below it. So what I saw here, we broke here, came up, good place to take profits. If we come back here and you enter the trade again, look to take some profits right into here, and then but look at this other zone up here. And there's also what we can do. We can take a Fibonacci retracement and see where it might line up. So we go from our peak to our low currently. Yeah, if we were to drag this up to here, so you take profits initially right through here, it's still over 3-to-1, and then you continue holding that up to this resistance right through here. That trade now becomes a 10-to-1 risk reward. So you can see how essentially once it's played out in our favor, we can adjust our stop loss up, and then we also look, and that's when I say don't look to sell everything on the first profit taking level that you've set. You know, maybe sell half here and then move your stop loss up, let the trade continue running. As it reaches other profit targets, then start to take more profits on a DCA out style. But you can see here, I do just use these support levels, and you see up here, we could return up to that 0.5. That being said, there is quite a bit of resistance right through here, and that is such a good risk return trade that I wouldn't really look to be pushing my luck beyond it too far. but we'll flip over. I'll show you a few other charts where I've used this tool and kind of explain how, kind of the thought process behind why I've put it there. So we're looking at Dell here. So Dell was one I've been watching. I've been showing you guys it on the charts on my technical analysis videos. We're watching this downtrend breakout right through here. So we're gonna see a back test, a higher low ideally right through here. We want to see that higher low supported with our momentum indicators. So we want to see these kind of reset themselves, ready for a bullish move up. But what I'll show you here is if I take my long position and would say this is where we're looking for our entry. Again, the entry is going to change slightly depending on kind of the price action that plays out. But we see here, if we hold this into our gap fill resistance right through here, and then we pull our stop loss up, we want it underneath prior support. It's just about, so 2.95, that's close enough for me in my opinion. I would consider that a valid target. We do see the stop loss just here below this low. If we break this low, we lose the market structure and we're likely to just continue to the downside. We're better off cutting that trade with a slight loss than riding further momentum down. So we just see here, it pulls up that risk reward ratio. We have a 30% move to the upside and about a 10% potential move to the downside before we get stopped out. So looking there, based on risk reward, it looks pretty good, but we also want to make sure that our momentum indicators are supporting that thesis when it does come back to our entry. But you can see how I just make this plan ahead, look for those setups, and then wait for the entries to come to me and execute them as they come. Flipping over to Intel, this is another one. So I'll show you big, strong, long horizontal support. We'll flip to the weekly here. You see all through here, Intel, we see acting as support, 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 and we're back at this strong horizontal support. You see we got a huge bounce from it. So we'll take a look at the low time or the lower time frame, get that idea of what's going on. So you see we're right through here. We did kind of have this downtrend breakout. So like that, broke out of this downtrend. We have this beautiful kind of into resistance, currently rejecting. So looking for that Fibonacci's golden zone entrance right through here. We're above our 200-day. We're currently above our 50-day and our 200-day. So looking really good in terms of kind of a potential uptrend or reversal, bouncing from this strong horizontal support. As long as we can hold these lows right here, I think Intel is good for another leg up. And you can see where I have it marked. So right up through here, this is a heavy confluence of resistance. You see this horizontal resistance zone I've marked. We've got this down sloping trend line that I've marked. And this is also Fibonacci golden zone resistance in through here. So lots of confluence of resistance. We've got our stop loss pulled down below all the support through here, because if we lose that support, we lose our market structure. But you see, 4-to-1 risk reward ratio. The better you can get this ratio, or the higher you can get this ratio, the better. That being said, you have to keep in mind that you can't just drag this wherever you want. So if you were to say, oh, well, look, this trade has an 11 risk to reward ratio because I put my stop loss right here. Well, that doesn't make sense to me, because lots of the times these golden zones are revisited as support. If we come back here just on a normal retracement, that's going to stop you out of the trade. And if this ends up being the low, it'll reverse to the upside and leave you behind. That's why I say you need to have your stop loss below horizontal support or below strong levels of support to avoid that kind of potential to come down, take us out of our position, and then reverse to the upside. But Intel's one we're watching and shows you a good opportunity trade there. NVIDIA, this is another one I watched, pointed out as a good trade. We saw this horizontal support here coinciding with our Fibonacci golden zone, as well as our 200-day moving average. So we saw NVIDIA come up, break out of here, come back, enter our position right through here. We targeted this resistance as our profit level, and we were able to put our stop loss below this horizontal support right through here. You can see that trade played out perfectly, a perfect 3-to-1 risk reward ratio. So that's kind of this thing I'm pointing out. Now we can use this tool to really gauge each individual trade. And then when I talk about risk, I start on the macro side of things. So there's risk in the markets, there's risk within our own portfolios, and then there's risk in every individual trade. And I've tried to kind of show you how we can attack each different level of risk and ways to mitigate that risk and make sure that we're maximizing our return. So thank you so much, guys, for watching. If you learned something new, if you like the content, please like, share, subscribe. It all means the world to me. And I'll see you guys in the next one.